Markets had a pretty rough day. There was the China tariff turmoil, raising rates to 245%. Nvidia got hit with a $5.5 billion export control fee. And this afternoon, Powell was pessimistic on being able to look through tariff inflation and was a bit more upfront with his policy concerns. However, amidst all of these wild headlines, if you just focused on the technicals, the market still held the critical support that keeps the bullish base case alive. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points, including threats to the base case, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart just to reiterate what the bullish base case actually is. We know that the Monday session of now 2 weeks ago opened on a gap down. This was like max fear. The market tried to move in the downward direction. You can see that based on the lower wick of that daily bar, but it did end up ultimately closing the gap and closing higher on the session. And I would classically call that a failure from the sellers to extend the losses lower, and that qualifies as capitulation. Now, after capitulation takes place, there's really 2 ways that the market can confirm the low. Number 1 would be a V-shaped recovery, which is a lockout rally straight back to the origin of the breakdown. The origin in this case would be up here, closer to the top end of the do or die zone at 573. And clearly that didn't take place. And there was a very impressive rally on the Wednesday session of last week when the 90-day pause was announced, but you can start to see that the market's fallen into some sort of consolidation here. So the secondary way that the capitulation low can then ultimately hold as the low is if the market can transition into a structural trend change. And a structural trend change here probably looks like using these previous highs, 1, 2, and 3. Previous resistance acts as newfound support and offers some sort of daily higher low against the capitulation low. And that level certainly held into the end of today's session. That level is exactly what we talked about on Sunday at 523.75. So the bullish base case here is that this is the capitulation low down here, and we're seeking a structural higher low to change the daily trend and then build out continuation in the upward direction, ultimately to the origin of the breakdown, which is still up here, closer to 573. And then we'll reassess when and if we get there. So that's the bullish base case on the daily time frame chart. And the first threat to that base case actually comes from the weekly time frame chart. So let's go on up a time frame here to the weekly. Let's talk about what this threat is. Of course, it's just the fact that the weekly trend is still down. We have highs, we have lower highs, we have lows, we have lower lows, and this is the lowest low in the trend count, which means that on the counter trend rally off of the lowest low, it's still very possible that the weekly chart could still be seeking some sort of lower high to continue the weekly downtrend. And it's also very possible that we use previous support as newfound resistance, the exact opposite of what we were talking about on the daily time frame chart. So this support turns into newfound resistance and offers a weekly lower high. So the first threat, once again, comes from this higher time frame weekly and would just say that if the weekly trend remains down, if this is confidently a lower high on the weekly trend, then it's going to be pretty difficult to look through that sort of threat, right? It's going to be very hard to find a daily trend reversal to the upside. Now, one of the things that I'm a little bit more optimistic about, though, is just the size of these ranges down here. If market volatility is starting to compress, which it is, I'll point that out to you in just a moment, then it's totally reasonable that the market's done putting in 10%, 8% range weeks, and we start seeing things that are a little bit more tame, 5%, 4%, maybe half as much volatility. So it's also possible that the weekly chart could produce a higher low on the weekly, right? At the same time as the daily is trying to produce a higher low. Now, that doesn't negate the possibility of this threat. It's still a very valid threat, and it's something that we're acknowledging here on the higher time frames, but we're also optimistic about the possibility for a higher low at the same exact time. So with that, we'll drop it back down to the daily time frame chart, and we'll talk a little bit about the candle structure that's going on here. The first thing I would point out is that on the Monday session, we opened on a gap up, and there was actually a pretty solid looking gap fill reversal towards the lows of that Monday session. Stronger sellers who were really trying to lean into the idea that this lower high up here from the weekly perspective that we were just talking about, it's the same level, it's really 550, right? Stronger sellers there would have not cared about the Friday high, and they probably would have tried to seek price acceptance inside of the Friday range. It's not really what we saw on the Monday session. Tuesday was a simple inside bar. We didn't really learn much about the trend of the market there. If anything, you might just read into that and say, okay, it was a balanced session, but above the high of Friday. Now, on today's gap down, this comes on a myriad of different news headlines, right? And I think that this is important. And once again, we will bring up the scale, the MF-EU scale, right? For anybody who's not familiar, we have max fear, MF, on the left-hand side. We have complacency somewhere in the middle. And over here on the right, we have little e and big U for euphoria. And on this scale, we know that this morning's headlines, in theory, right, I see it in the morning show, right? It's kind of an interesting data point to have. Everybody comes to the morning pre-market prep saying, oh my God, can you believe tariffs are at 245% on China? Nvidia just got whacked with a $5.5 billion fee. You would think that the world was ending. And rightfully so, the market gapped down a little bit. We were underneath the Tuesday low, but did we break back down underneath this set of critical highs that we've just pointed out as the do or die area of support, which maintains the opportunity for a possible daily higher low, 523.75? No. With all of those bearish headlines brewing through the overnight session, I mean, people in the chat seemed to think that it was max fear again, when in reality, the market didn't really budge or react as bearishly to the initial wave of the tariff announcements and even the reciprocal tariffs from China back to the US. So it's my belief that the news cycle is actually getting more tame and working its way towards complacency, which is another hallmark sign of the capitulation low actually being in the rearview mirror. So I will fully acknowledge it's not a bullish thing to gap down in the market. Do not get my words twisted. This is not a good look for the buyers in here. But the fact that this was happening on really, in theory, extreme headlines, and yet the market still held critical support, that's starting to look a little bit more so like structure is changing in the upward direction, and the news cycle is actually getting less intense. The market's not responding in as much of a volatile manner. It's not so much of a knee-jerk reaction, right? So the fact that that's holding here on the daily time frame chart is enticing to me to continue with this base case and continue with the idea that a structural higher low changes the market from, oh my God, it's the end of the world and the market's going to go to zero and it's going to crash and burn, to nope, the market is going to climb the wall of worry. As long as the market can maintain price action over 523.75 on the daily time frame chart, I would be optimistic about this reversal in the upward direction. Now, please ignore the upper wick of the daily bar. There's a little bit of a data issue here on Thinkorswim, but if we go on down to the hourly time frame chart, what we can see is that there was an attempt to close some of the gap overhead on today's gap down, and then the Powell conference sort of pushed markets in the downward direction. There was an overshoot of 523.75, but we did close the daily bar back above. We just saw that as a valid lower wick on that daily structure. So if I'm counting trend here now on the hourly time frame chart, perhaps it's a little bit cleaner to see the pattern, right? Here's your double bottom, here's your breakout. This undoubtedly is still lows, higher lows, and although there was an overshoot on the first pullback from the 90-day pause rally, this is still a higher low in the trend count. I mean, objectively, this is a higher low. I'm pointing to it, right? It's an arrow from the lower left to the upper right, lower left, upper right. If this can hold here, a little bit of overshoot, but still, it's an arrow from the lower left to the upper right. There's no arguing with the technicals that this can possibly hold as a potential higher low in the daily trend count. What I'll also throw in, as we're talking about the importance of 523.75 here, is the anchored VWAP set. If we do something intraday, where is it? Here we go. Notice that the overshoot went almost directly to this little cluster of anchored VWAPs, which really start from the top of the move, the first gap down, Friday's gap down of 2 weeks ago now, and then Monday's gap down, the capitulation low of last week. The market did not break underneath the cluster of anchored VWAPs. So what might that suggest? It's really twofold. Anybody who bought the lows down here is feeling good about their position, obviously, and the average short seller from any of these anchored VWAPs onward really are not feeling good about their position. So as I go back to this concept of the market climbing the wall of worry, the fact that shorts are not getting paid on this move, and don't get it twisted. Anybody who shorted the exact highs back here, Monday, Tuesday, fine, they're making money. I'm not here to argue about that. But generally speaking, this overshoot doesn't look so arbitrary in hindsight now when we throw on the anchored VWAP spread. So as long as price can maintain some sort of acceptance over 523.75, I'm bullish on the S&P 500s. And to me, this is nothing more than an opportunity to offer that higher low. The next steps for the market would be to either intraday tomorrow morning, give a test of 523.75 and rally to close the gap. If we just get an opening drive to the upside, something that would be really bullish would be acceptance inside of the Tuesday range. Any higher low over 536.60, I would immediately expect a rotation up to the top end of the inside consolidation, 544, and then some sort of attempt at the weekly lower high threat, which is 550, much closer to an on par equal high to what we had from the Wednesday euphoric rally. Now, where does the base case get challenged on the hourly time frame chart? Of course, it's just price acceptance underneath 523.75. In the post market, we're doing all right. We're holding in there around 525.86.98. So call it 526 flat, meaning somewhere around basically unchanged from the close. Not bad. Really not bad. It gives an opportunity to open at the level, confirm it, and rally away from it in the upward direction. If the market opens and falters, it would need to be almost an instant inverted head and shoulders, something that looks like this, if I'm going to maintain my bull stance. If the market falters underneath 523.75 prior day's low, anchored VWAP cluster, I would have to undoubtedly change my tone to neutral, and this is where we have to keep in mind sound risk-reward principles, right? And I'm realizing now, too, that tomorrow's the last day of the trading week. There is no Friday to extend this out to, but sound trading principles tell us what? Do we want to be shorts at the lowest low of the trend count here? Probably not. That's not setting yourself up for good risk reward. And instead, if the market extends the gain underneath 523.75, fine. I'm not going to be shorting this at the lows, but any rallies that then reject that for a lower high, which change the trend now on the hourly time frame, this becomes more concerning for downside. And that is where the base case is broken. That is where I will wave the white flag and say, you know what? Maybe it's not over. Maybe the market's going to chop around in this range. I will no longer be bullish for the base case if that unfolds, okay? So there you have it. That is what I'm looking for out of the S&P 500. We could also throw in here the Fibonacci's for a little bit of confluence coming from the low of that Wednesday session to the high of the Wednesday session. Remember that the Fib 38.2 is right at our critical level at the 523.75, reinforcing the idea that if we can hold up above that, not all hope is lost. I think that the bull side is the correct side to be on. Remember also the general stat that markets tend to trend in the upward direction, and I'm referring specifically to the S&P 500. We had a little bit of a back and forth on the lost decade from Japan, of course. Not all markets trend in the upward direction 80% of the time, but the S&P certainly has a track record to do so, right? So that's the hourly analysis. Those are the anchored VWAPs. Those are the key levels. And you know where I changed my tone to saying, okay, the bullish base case was wrong. Let's take a look at the market internals and see if this can help support the case for the bulls or the bears. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. I get questions sometimes about what are these videos that you're pointing to in the top right-hand corner? There should be a tutorial pop-up that comes across the screen from YouTube. If not, check the description of the video. Anyhow, for today's session, how did we fare in terms of breadth? Breadth really wasn't that bad prior to Powell. It was much more indicative of the sideways chop that we were actually getting on the session. Notice that the market was really sideways ahead of Powell. There was the overshoot of the level, then the closure back above post-market, It already looks like that 5,300 is trying to act as support again. If you look at any of the other indications that have taken place here, so outside of the breadth extending to the downside here in the afternoon session, how else were the internals acting on the week, right? Because what we care about is were aggressive sellers hitting the tape up here saying, oh my God, this is such a great opportunity to short the market. Oh my goodness, the market's going to go down. This is such a juicy spot to be loading shorts. That's the question that we're trying to ask and answer on the internals dashboard. If you take a look at the volume flows, absolutely not on Monday, not really on Tuesday, much more flat than anything else. If you look at the cumulative build out of the tick, it was positive on Monday, flat on Tuesday, flat on today's Wednesday session, even with the end of day route. If you look at the advanced decline line on Monday, it was in positive territory all day. Same thing on Tuesday. Today, faltering a little bit on both sides of the zero line, but ending up the day negative. Not a shocker considering that the market did move lower on the Powell speech. But regardless, it's still that opportunity for the higher low. The question we're trying to get the answer to is, were aggressive sellers hitting the tape? Based on what I just walked through, I would tend to think that the answer is no. Sellers are not really getting aggressive here. And if anything, it looks more so like digestion. Let's not forget that Wednesday's breakout on Wednesday of last week, returning over 10% on an individual session. Some consolidation of those gains is not out of the ordinary. Let's jump on over to the market profile and see if we can learn anything else about these wild markets that we're trading right now. If you're not familiar with the profile, again, here I'll point to it. In the top right-hand corner should be a video tutorial popping up on the YouTube banner. You might need to turn on CC, closed captions, or annotations, I think it is, from YouTube, and then the video tutorial will pop up. But regardless, what do we have for today's session? Amidst all the selling, we do have ourselves a double distribution. You can see it's separated by I-period single prints right around in there. And the point of control did drift lower, but the overall value area is pretty evenly distributed from the upper and lower distributions. It would be really interesting to determine tomorrow whether or not the market finds more acceptance in the upper distribution or more acceptance in the lower distribution. If the market accepts in the higher distribution, I think it's, signed, sealed, and delivered. Let's see if we can spot that. Well, not see if we can spot it, but the higher low is in, and we're seeking some sort of continuation back up towards the equal highs. We have a very poor high from the Monday session, Tuesday session, lack of material excess in the L period. If we just zoom in here, and there might be a little bit, zoom in a little bit further, there's a little bit of excess down here. It's really been tough to say in the new regime of volatility. Is 4 TPOs enough? Is 3 enough? Do you need 5? Do you need 10? It's kind of difficult to say, but I would call this a decent excess low as I zoom in closer to that relative to certainly what we had in some of these other tops where it was much more flat across. So anyhow, that is the market profile. I don't think that it confirms anything so far. It would definitely would not confirm that the bears are totally in control. Remember, if bears were in control, then these single prints from back over here on the Wednesday rally should have closed instantly on the Thursday follow-up. That was not the case, and this was really our first major indication that tipped me off at least to say, hey, if markets start to advance away from that failed closure, I want to be a bull. Right? Sellers are not doing their job. That's huge market-generated information, and that's sort of what we dove into in the Sunday update video. So that's the market profile. Again, be mindful of your double distribution here. If you don't have market profile, if you don't know what the numbers are quickly in the ES, we've got 53.43 as the top end of the single prints, and at the bottom end of the single prints, we have 53.1775. 53.1775. If you want to translate that over to S&P figures, you could take a look at the cash level of 529.64. That's your upper distribution here. And your lower distribution, of course, is going to be underneath 525.92. Something along these lines right here. Which area does the market accept above? You could use this helper level, which is why I have it mapped on the screen in the first place. It was Thursday's open of last week. It was the consolidation lows, give or take, of this morning's open. 531.75 could act as your helper level, where if we were to set some sort of higher low above that, that's where we're looking for the upside, right? So looking for bullish setups here around the 523.75. So long as price is above that, we want to maintain the bullish base case, and really nothing has changed here. We know that after a higher high, the market can easily afford a pullback to set a higher low. This absolutely is from here to here. We go on to produce a mostly equal high. This is still an opportunity for a higher low from here to here, as we've outlined so far in today's episode. With that, let's move along to our good friend, the nasty NASDAQ. On the daily time frame chart, let's see how the NASDAQ fared. And what we'll see is a pretty similar picture, to be honest with you, where the base case still stands, capitulation low, looking for a structural higher low to be the next development. That would be over 441. Lower wick on today's session is valid. This is not suggesting with a fake print that the gap has closed, so that's all set there. And as long as the Qs stay over 441, then the base case lives on, and I would maintain that slightly more bullish stance where we're looking for a higher low here to be a daily/weekly higher low, right? We'll go to the weekly chart real briefly so you can see the threat of the lower high here. You can actually just see it on the daily chart, right? Overhead supply very clearly defined at 465.85, If we take a look at the weekly, you can see it's the same thing, right? If I just draw a line across, previous support, you have highs, you have lower highs, possible lower high here. You have lows, you have lower lows. You're technically coming from the lowest low in the trend count, which means that the counter trend move can still offer the threat of a weekly lower high. The weekly trend is still going to remain down unless the daily higher low is coincident or coincides with the weekly higher low, daily higher low as well. Once again, that's 441. We just saw that on the daily time frame. So let's go back down over here. Let's take a look perhaps at the hourly time frame chart for some pathing ideas. You can see an exact rinse and repeat analysis basically of the S&P, where here's your double bottom, breakout through the neckline, First overshoot is still technically a higher low from here to here. A little bit of overshoot again, but still technically a higher low from here to here. We are pulling back from the highest high in the trend count. It's an equal high, much more so in the NASDAQ versus the S&P. The buyers were unable to really close the gap overhead, so you might want to carry that forward as a subtle weak data point here, but nothing that's going to sink the ship, in my opinion. That's sort of the way I would frame that. I'm going to add in a helper level here in real time at 449. We're going to make that dim gray and dotted. There we go. And that could also act as a tradable level for tomorrow, right? Where if the market's holding a higher low over 441 post-market, we're at 444.25, give or take, unchanged from the close, basically. If the market's holding over 441, I would say you could look for rallies to accept over 449 and then trade for the gap close, in which case your risk and reward is something along these lines, right? And that could certainly be a scalp for tomorrow's session if the market wants to play nicely and see this continuation trade in the upward direction. Beyond that, price acceptance over the Monday low at 453 then becomes attractive for the equal high retest. And of course, you're just building out small time frame uptrends to get to these equal highs. If you can go lows, higher lows, higher lows, higher lows, who knows, maybe there's another higher low in the trend count, all of these equal highs, 1, 2, 3, you only knock on the door so many times before somebody opens up. And as we've been pointing out in the pre-market live streams, if you can get this test, this equal high pressure after subsequent higher lows, 1, 2, 3, right? That's improving the odds that the sellers are going to throw in the towel. If you're short, let's just say that you had some sort of crystal ball and you shorted the exact high of the Wednesday rally. Great, you see a push in the downward direction, it snaps back, you're like, this isn't really comfortable, but whatever, I'm going to hold on to it. Moves a little bit lower, you get a little bit nervous again. Oh, look at this, it's working out again, but if it starts to rally back up to the equal high, third time might be the time where sellers say, wow, I didn't take profit here, I certainly missed this low, we're retesting my entry again. Is it possible that should I just get out of this thing? The QQ, again, we're putting ourselves in the shoes of a seller at 465.85. So you can see how all the equal high reattempts at the same level after a sequence of higher lows becomes a little bit more compelling for that level to actually break, and that certainly aligns with the bullish base case we've outlined so far in today's episode. Let's turn on the anchored VWAP spread. Same exact analysis as the S&P 500, with the buyers feeling pretty solid about anybody who's getting involved after the capitulation low, and any of the shorts, the average shorts, so to speak, after this big drawdown, not really getting paid anymore from an anchored VWAP perspective. If we want to be congruent with the Fibonacci's coming on the Wednesday session, the 38.2 was overshot, but we talked about this on Sunday, that it was not direct confluence with the key level, and the key level, and this is just a general concept, right? Key levels always supersede in analysis Fibonacci levels, for example. So with that, let's clear that up. Let's take a look at the NASDAQ side of the market internals. Let's see if there are any big discrepancies over here. I would say the answer is no. We have on the Monday session solid volume inflows, very flat on the Tuesday session. On Wednesday, of course, with Powell, we are moving lower here. Aside from that, Monday, Tuesday bullish out of the advanced decline line, a little bit more bearish here as opposed to neutral on today's Wednesday session, and rightfully so, with the tariffs both impacting Apple as well as Nvidia, right? The Nvidia export fee there was pretty hefty and generally not spelling a solid tone for the tech side of the market. If you look at the cumulative tick, though, Monday is pretty solid. Tuesday is exactly flat, and a little bit of a bearish build today on Wednesday. But with the key hold of the level, again, I come back to that question of, are stronger sellers really loading the boat here? Is this an opportunity for sellers to really hammer it in on the lower high? I mean, you're just not seeing the proper volume flows on the Monday session. Tuesday's follow-up is an inside day. That would be an easy opportunity for sellers to absolutely load the boat short. You're not getting that across any of these internal mechanisms, right? Let's take a look over at the market profile for the NQ side of things, perhaps having to give this a little bit of a reset. There we go. Rinse and repeat the S&P analysis, where as I zoom out, remember that all of this really stemmed from the fact that the sellers were unable to close the single prints from way back over here. That was our first bullish indication. This is the unclosed singles in that circle. As we take a look at today's session, we do have that I period individual single prints forming a double distribution, upper and lower, down here. And you'll notice that on the NASDAQ side, excuse me, the NASDAQ side of things certainly has the point of control in the upper distribution, and the value area is much more skewed towards the upper distribution rather than the lower. So I would actually carry this forward as a more bullish data point for the NASDAQ, which, remember, is certainly a major influence over the S&P in general. Let's take a look back on over at the platform. Let's finish up our big three indexes. Boy, oh boy, we'll get it right someday. On the IWM, what's the daily base case? The daily base case is that we just want to avoid the chop zone, and so far the market's doing an okay job of doing that. I'm not going to say a good job, but an okay job of doing that. This chop zone in here is brutal. It's underneath 184.50. You can see that on Monday's session we did get a gap fill reversal. On Tuesday, though, instead of an inside bar, what I would like to emphasize here is that the market did, or small caps, did try to break out over the Monday high and were unsuccessful in finding acceptance outside of that range. There was no full test of the Wednesday highs, the Monday highs from the previous week. And on today's session, we did dip a toe back down into the ugly, sloppy zone that's underneath 184.50. Although we closed above this failed breakout over the Monday high, it's a little bit more concerning. An inside bar there would not have been as nearly as bad, right? Simple logic behind that is if the buyers didn't attempt to break out, then you can't call it a failed breakout. It's just there was no successful there was no trigger, so to speak, of an expansion of range outside of the prior day's range, where in this case, you should entice new buyers to get involved as you're expanding range in the upward direction. So little cause for concern there on the daily structure in terms of the bars, but nonetheless, we are still technically over 184.50. I think it would be irresponsible to not point out that on the weekly time frame chart, this is like brutally below its key lower high area, and this is even a monthly lower high threat. So although it's holding, all sorts of, I was telling you in the afternoon stream that it's that coffee. Goodness. Deep breath. The weekly threat is just, it's so much more compelling out of small caps. And even though we're holding outside of that choppy, sloppy zone on the daily, 184.50, anything that's still underneath 198.200 is really not optimal for small caps here. Could you make the argument that a higher low could persist and so on and so forth, like the S&P and the NASDAQ? You could try to make the argument, but it's just not, in the grand context of the weekly trend, it's not nearly as compelling, so I am carrying that forward as a more bearish data point over in smalls in particular. As we maybe drop it on down to the hourly time frame chart so we can see this, look at that upper wick in the first hourly bar of the Tuesday session, attempting over the Monday high, especially after a gap fill reversal hold off of the Thursday and Friday high of the prior week. Not seeing any follow through to the upside once again is fairly concerning. Where were the buyers? Why were they not stepping up, right? As we look at what happened today, again, you didn't close underneath the 184.50, but it starts to look a little bit more compelling for a rolling over look here, as opposed to like, oh, that's a clean higher low and the structure is, undoubtedly building out to the upside. Instead of having a mostly equal high here, I would just point out that this is more so a lower high, certainly relative to what we had in the NASDAQ as well. If we bring out the intraday anchored VWAPs, we are holding that cluster here, so I guess that's a small bullish data point for Rusty Russell and the small caps. However, not holding my breath on small caps. Let me frame it that way. I'd be pretty neutral through here. The only time I would start to get a little bit more excited or feeling compelled about a better long-sided pressure from small caps to the S&P is on a Brigade bolt out of the Monday, Tuesday highs, that rejection point at 187.75. So if you can spot this bullish path here, great, all aboard the long train in the S&P 500. If you're just neutralizing like this and then threatening drift to the downside, starts to look a little bit uglier for the S&P, and you could carry that forward as one of the threats to the base case all up. If you bring out the Fibonacci's from the low of the Wednesday session, once again for the sake of congruency, we are over the 38.2 with a little bit of an overshoot here. Seems more like range compression to me more so than anything else, rather than a sustained clean hold of a higher low, primarily coming from this main idea that this is much more of a lower high than the other two indices. With that, we'll take a look at the Rusty Russell side of the market internals and see if there are any big discrepancies here. The answer, of course, is no. Monday volume inflows, they're not as substantial as the S&P or the NASDAQ. Flat Tuesday, a little bit of outflow on today's session. You can see similar here out of the advanced decline line and some pretty flat cumulative builds on all of the sessions. Wednesday's session today, a little bit more bearish, nothing out of the ordinary based on what we've seen thus far. If we move on over to the Rusty side of the market profile, no single prints to delineate the double distribution. Point of control is pretty centered in the overall profile, and the value area is slightly lower underneath that Tuesday attempted break. What you'll also see here, if I zoom in, right, as we're thinking about the opportunity for a breakout over Monday's high, value didn't even come close to migrating outside of that. It was just a couple of morning session upper wicks in that A and B period, basically the first hour of the session, and then a failure to spend a majority of the session back inside of the value from the Monday, right? So not really seeing any follow through from the buyers. Very poor high on today's session. A, D, and E period straight across the top. Decent excess on the lows thus far. Maybe worth carrying forward, where if we retest the highs, maybe we should expect it to break on the first test, but sort of remaining reserved in the overall outcomes for Russell to put in a dramatic reversal to the upside that's going to be of note, right? There's just too much of a threat on the higher time frames still, and it doesn't look like a structural low has really started to build out here. You've maybe got an argument for like inverted head and shoulders with overshoot of the neckline. At this point, like I was saying, this is like, okay, this is a little bit better. Really get over Wednesday's high, get over this 190.25, at least get me into the weekly threat zone, and then we can have a more serious conversation about whether or not we should be optimistic about a breakout there or just a big old lower high and a bigger threat to the broad market. With that, let's wrap up the indices and jump into our sector analysis for the S&P, starting with our weekly performance, who was leading, who was losing, and where was the weight. Leading the pack here this week is so far real estate up 1.5%, followed by the TLT long bond, and then the XLU utility sector up 0.08%. At the bottom end of the barrel, it's the semiconductors getting absolutely walloped, down 5.94%, followed by the tech sector, followed by discretionary. Those risk-on sectors are taking a beating here as we're dealing with higher China tariffs as well as that Nvidia-specific charge, really pressuring semiconductors. And as we'll see, ASML, the first semiconductor, if you will, semiconductor-adjacent earnings announcement came out before the open on Wednesday. The Dutch lithography makers really reported a lot of uncertainty, rightfully so, around the orders, but also some slowdown in terms of growth. That is noteworthy. It's not outright risk off, but it does not look as compelling as it could on the pullback, and we'll get to that as we go through these sector charts. Real estate, fine. It's making an attempt higher towards the neckline of maybe this as a head and shoulders. 41 retests are great, but ideally it's just the structural higher low. Over 39, we'll watch for it. It's lightweight. It's not going to make or break anything. Bonds getting a little bit of reprieve here off of the lows, driving rates a little bit lower, obviously inverse to the TNX for the most part, which is helpful. But we'll see if this does roll over for a lower high underneath this overhead supply at 89.50, and thus pressure rates, TNX, back in the upward direction. Based on Powell's commentary in his not really press conference, but sit down today, it doesn't seem like they're in a big rush to cut rates, given what he talked about. We'll get into that momentarily. Utilities, the most bond-like sector, more sideways inside of this consolidation range. It's not going to help the risk-on rotation, so we'll let that be. Semiconductors, no good. No good. It's really got to do something tomorrow to finish out the week over this 195.15. If you recall from Sunday, one of the things we talked about is this sort of dichotomy of exactly what we had on the S&P, right? We have the opportunity for a weekly lower high here, but also a daily higher low down here. And you can see that there's clear overshoot out of semiconductors on today's session. And thus, if this is going to play out as a classic hammer indication, you would need to get over the high, close the gap, and then any subsequent pullbacks need to, no ifs, ands, or buts about it, would need to hold up over 195.15, rotating back up to the highs. If the semiconductors stay underneath 195.15 and consolidate and drift, you're going to be hard pressed to find an S&P trend reversal in the upward direction. It's just not going to happen with one of the most risk-on heavyweight components of the tech marketplace right now, lagging behind on some of this news. Let's take a look at tech. Speaking of the XLK, you can see that we're doing okay, a little bit better here out of the XLK, not specifically the semiconductors themselves, but 190.75. If that can hold, which it certainly did in the lower wick of today's daily bar, then great. You have the possibility of that higher low. Once again, your threat is still up here that you would need to blast off through the previous lows, which in theory are acting as resistance once, twice. If you can hold this higher low and reattempt, that's where you have better odds of going through and continuing the trend to look something like this over 206.40. So the base case lives on here in the XLK. The SMH is certainly something to pay attention to, but if you want to narrow this down to, okay, what are literally the 11 sectors in the S&P, the XLK is the top dog. Let's take a look at discretionary, where suddenly the picture doesn't look so good once again. Earlier on in the week, doing pretty solid to hold up over that 188. Today, not so much with the failure underneath 188, the three prior equal highs, rejecting there, and you can see certainly underneath this shelf for a lower high on the higher time frame. This is a white flag for the market. Watching this very closely, it's bearish pressure just outright right now for the S&P, but as long as the XLK is holding up over its key level, that 190.75, we'll give it the benefit of the doubt. The S&P that is looking for that upside. XLC is a similar picture where it would be better if the XLC was over 91. It's not. The XLC is not the heaviest weight risk on sector, so it's not going to sink the ship outright for the S&P, but between the two key levels, you certainly have the sellers prevailing with the lack of hold for a higher low over 91 and just not even an attempt for a lower high up here. It didn't even need to happen. You have highs, lower highs, and you're already producing some sort of rotation back under 91. So the most dangerous thing that could happen, right, is just a Brigade Bolt lower high in range, confirms look above and fail. Target should be the bottom end at 86. That would certainly pressure S&Ps to the downside. The only thing that could combat that is confluence out of the XLK moving higher, as well as the XLF moving higher, which we'll get to in just a moment. Industrials, what do we have over here? Over the key area, but still rejecting the secondary key area, if you will. We have the overhead lower high and the potential higher low. A little bit more neutral here out of industrials. Let's take a look at financials, holding up over a key area. So far, remember that the XLF, second heaviest weight sector, XLK, where are you? There we go. First heaviest weight sector. So as long as these two are over their key inflection points, this one 46.40, certainly getting close, threats and testing, right? But as long as we could stay over that, I would be a little bit more optimistic about the bullish base case in the spiders themselves. Let's move along to the XLB, lightweight sector. Need it to break out in the first place. Not there yet, not a concern. If we look at healthcare, it's D for defensive. Did not break out, not really a concern. If it goes, awesome. If it holds 136, awesome for a higher low, not going to hold it to it. If we take a look at energy, consolidation down here, this to me is still maybe along the recessionary theme, which we'll talk about when we get to growth and Powell's comments in just a moment. As we move along to the XLP, consumer staples, risk off in terms of an asset class. Maybe a higher low here. The fact that it's not breaking out through these highs, the fact that it's not leading the charge to the upside, that's a little bit compelling. If it was and the market was rallying on that, that would not be as much of a strong structural low that we're looking for in the S&P. With that, let's take a look at the ratio charts here, see if the market's signaling risk on or risk off. We have some green shoots still, right? Green shoots are starting to emerge here. The XLF looks great. The XLY not so much, and the XLV a little bit more neutral, being a defensive and risk-off sector. As we look at the risk-off sectors themselves, though, XLP really not helping the case for a risk-on rotation. We'll drop an X there, and the same thing here out of XLU. So green shoots need to develop into more out of the XLK, which is basically me just saying that this needs to sustain the hold over this key structural area as the S&P potentially consolidates, or it needs to rally and rally more so than the S&P to confirm that the ratio is actually outperforming here. As we get into some specialized risk-on, risk-off charts, we know that this green shoots, but the rollover, not really a great look here. This was green shoots, no longer looking good. This is no bueno. This is no bueno over here. Neither is this. So it's pretty tough to say you have a risk-on style rotation that's just, flushing or washing over the market like a wave of risk-on sentiment. It's just not the case given what we have here. I'm going to still maintain the bullish base case over the S&P daily higher low, but it would be better if these indicators started playing more nicely on the long side. If we look at the risk on-off B charts, I've basically just parsed out gold and the treasury bond on the same screen now. This is flight to safety out of gold. We saw this take off like a rocket ship as Jerome Powell started talking this afternoon. That's not really signaling confidence in equities, nor is this subtle uptick over here. What we would watch for next out of the TLT ratio to the spiders themselves is some kind of lower high. If that can persist and then some sort of move back down towards this base area, it's roughly 40% on the actual ratio itself. Don't get too concerned about the actual number, but the structural level in here, if we can see a rally that then comes back down, that would start to look a little bit more compelling for, okay, risk off was like a serious threat that people were considering, but now it's looking a little bit better risk appetite wise for equities. Let's move along to the dollar. Speaking of currencies with gold, it continues to get absolutely demolished over here. A little bit of commentary from Powell on that today, just sort of warning and sort of giving people the advice to say, hey, let's not try to tie the outcome of this downdraft with a very specific reason, and we'll sort of be able to see that in hindsight, which, like, thanks. That doesn't really help us in the here and now, but that's kind of his perspective, at least. My perspective and our perspective, right, as rates and bonds sort of went all over the place, was just that the return to home trade was sort of taking place as the uncertainty was sweeping over the U.S. equities market, dollar, same thing with treasuries, rates, of course, everything. It was like, let's just get rid of all this stuff and then bring our currency home. And you could really see this out of things like the Euro chart, right? We've been bringing up the 6E every now and then, where this has just taken off like a rocket as soon as the tariff implementation was taking place. Even the Japanese yen, right? The 6J, is it? Yeah, 6J, same thing, moving in the upward direction, pressuring, of course, U.S. equities, as well as just that relationship when it comes to foreign investors in U.S. markets. So that's what we've got going on from a technical perspective on rates and the dollar. So we look at the inverted ZT to get a sense for how the market might be feeling about Powell. You know, this like, oh my goodness, 5, 6, 7, 8 rate cuts into the end of 2025 has subsided a little bit, but still we're on pace for some rate cuts undoubtedly. If we take a look at the Fed Watch tool, you can see that the current probabilities are almost unchanged after Powell's speech here at 83.7%. This morning it was 82.6, if I'm not mistaken. It's basically unchanged, but we still have 1, 2, 3, and then 4 rate cuts into the end of 2025, and then we will reassess for 2026, which is still the market saying, hey, the Fed's likely going to intervene at some point based on concerns about growth, which Jerome Powell did acknowledge in his speech today. He was talking about supply chain disruptions from tariffs really not allowing the inflation to remain transitory, and these structural changes in the way that business gets done is probably going to be more persistent, and he did put a timeline to it. He was saying multiple years, not just a one-time shock to pricing, but multiple years to work out these supply chain issues if the tariffs stick and ultimately end up causing all sorts of disruptions. He was also very, in his business editors panel talk, he was very buttoned up about not wanting to comment on policy, but at the Chicago Economic Club, he definitely, you could almost hear it in his voice. He was like, well, you know, there's a lot of uncertainty out there right now, and I don't think it's making a lot of people happy. And, you know, he definitely gave a little bit more of his opinion, even though you had to read between the lines, about his lack of, not too fond of what's happening from a policy perspective and the way that everything has been shaken up so aggressively, right? So that was a little bit of a rare side of Powell that we got to see today, but it did come out nonetheless, and the market maybe keyed off of that by moving in the downward direction as he was speaking there. If we take a look at the calendar for the remainder of the week, really it's just Thursday, we have the typical jobless claims there. Looking at 225,000, Jerome Powell did comment that the labor market is A-okay. They're really not in a rush to cut rates to, you know, to, what would you say, stimulate growth out of the labor market. No issues from that front. And then we know that Friday is Good Friday. Markets will be closed. Perhaps we do a Q&A live stream in the morning or just do some analysis prep for the weekend video there. There's a great point on retail sales this morning. We saw that the data came in way better than the expectation. Oops, if we give a little refresh here, there we go. There it is. 0.5 on the core and a 1.4 beating expectations on both fronts here by 10 basis points on each front. That really sort of, it was like, okay, great, consumers are still spending. And someone brought up a great point in the chat, which was just like, okay, if people are still spending and credit card data is holding up, what about delinquency rates on credit cards? And lo and behold, I knew this statistic, right, was also rolling over, but here's the actual proof, right? So delinquency rates in the past were pretty high. You're talking about the great financial crisis back here really spiking up towards like 6.5%. As of right now, we're not even at half of that, around 3%, 3.08%. As of the last Q4 read for 2024. It's not to say that things can't get worse, and it doesn't always correlate with a recession. Let's be clear about that. But as of right now, it doesn't seem as though the consumer is overly hurt, right? And we've seen this big disconnect in the data, actually, where consumers are very pessimistic about what's happening. But the reality of the situation, you honestly saw this with some of the flight information when, Delta and United reported earnings. Like, there's a lot of spend right now on Euro vacations. Well, if everybody is so pessimistic about the economy, why are these lavish vacations being planned? So anyways, there's a disconnect, and the credit delinquencies here out of cards is certainly telling the story as well. So not really concerned about the market breaking based on the consumer yet, and we're also not seeing it in the labor market, right? So we take a look at the earnings calendar. ASML, as we were saying, was the first taste of the semiconductor industry, and so far, not really looking good on the tariff information that they've put out. And then CSX, after the close today as well, reported some pretty weak numbers, and all the old school folks who maybe use transport theory, right, Dow transport theory, would just say, like, this is a huge warning sign straight across the bow. Recession is imminent. When the transporters are not really moving product, or if freight is on the decline, you're not dealing with an economy that's booming, right, so to speak. So here's a couple of headlines just to reinforce that. ASML stock drops. Its earnings are a look at tariffs hit on chips. As we take a look over here, where was it? Company gave an underwhelming forecast for sales, saying tariffs have increased uncertainty in its market. Not really a shock over there from Barron's. Thanks for that. And then over here we have CSX from AP. Profit drops 27% as the railroad shipments decline in the first quarter, right? So transport's kind of contracting here, not really confirming that we have a booming economy where everything's flowing and things are moving across borders and all over the place, right? Not the case. Transport's taking a little bit of a hit there. Let's jump back on over to the platform. Let's finish up our technical look through the supporting indication indicators. Let's start with bonds relative to themselves. On today's session with Powell, a little bit of a rollover here in these trends. Nothing that's overly concerning. When this starts to make a sporadic move, I would say maybe the longer end of the curve has with this breakout here, but if this starts making a more sporadic move, we might include it. I don't know. You guys let me know in the comments section. Is that of much value to you or not? Typically, I find that even myself, I breeze over it most of the time. If we look at credit spreads, definitely more meaningful, more so sideways than anything else. The best thing for bulls right now would be to see a contraction here. It hasn't happened yet. So as I'm thinking about threats to the base case, if credit spreads take another leg higher, which they easily could do, I'm not saying that can't happen, that would certainly hurt the base case that the S&P should be looking for a structural high or low and a grind in the upward direction. As we take a look at, let's move along to the HYG in isolation. This is junk bonds, of course. You can see that we don't really have that equal high, but we are staying outside of this range, and there was not as deep of a pullback to get the retest of the top end of the range, whereas in the S&P, you can see the full retest down here. What about the LQD corporate grade bond? Let's take a look at that. Big double bottom reversal after the major market reversal here and up to the neckline just now. It would be more compelling if this broke out to the upside to confirm that we are looking for the follow through out of the S&P equity side as well. Let's jump into Bitcoin and see what's happening with the digital gold. As we zoom in, the Sailor Shift tool is still not signaling a risk on indication for Bitcoin, which is not a shock considering all the strength that gold has had recently. It's a little bit more neutral in terms of market indications, but I will just go out on a limb and say it's at least not bearish. Right? That is important. It's at least not bearish on the breakdown because these are weekly bars. Last week, if this was going to be more bearish, more of a risk-off indication for equities, a break of 71.5 would have been more telling. It simply did not take place. As we look at total breadth, small improvements this week, but nothing major. Small uptick, small sideways tick here, still well below the 50% mark on the moving averages, but new highs versus lows reaching towards the zero line. Ideally, we get positive there, but steps in the right direction. As we look at the RSP, just to compare and contrast where we are relative to the equal highs, we're trying to hold up over the key level. That's 161 out of the RSP. If we're taking a look at the QQQE, you can see a similar story over here, just a different number at 81.25. So if the equal weight ETFs can hold up, that would be a bullish indication across breadth, and we'll watch that show up in the total breadth screen as well based on the moving averages. Dow transports, if we want to just check in on the transport theory, right, you can see that transports are lagging. They never really broke out through the top end of the range. Wednesday did a little bit, but all the price action since has been back down underneath. That confirms what we were just seeing from CSX. If you're old school, right, you can use that, but has it really been a useful relationship through basically all of 2024? The answer has been no, right? It really has not been the way the market's moved recently. Let's take a look at the VIX. Volatility, I find this quite compelling. As the market gapped down this morning, after the market gapped up on Monday, you're still not even taking out Monday's high out of the VIX. So is volatility collapsing a little bit here as we maybe put the capitulation low in the rearview mirror? Certainly seems like the answer is yes to me. The VIX now being a slightly skewed metric of volatility. Nobody trades 30-day SPX options anymore. So let's jump on down to the VVIX, volatility of volatility. Just an indication that hedges are maybe unwinding here a little bit as the VVIX comes in to the 120 zone. We're continuing to watch that, but once again, the same comment stands, where with the gap down today, volatility is still technically lower than where it was on Monday. That's a compelling story for the capitulation low to be in. If we look at volatility futures, the contango is not yet in place, but the backwardation is less steep compared to where it was back here. You could think about this and the depth of this thick white line as being the steepness, if you will. Oh, it's just up. Where did it go? If we maybe do this, come on. Oh, it's because we're looking at the XLK. Duh. Let's go VIX. VIX futures. There we go. The steepness of this curve. You can see how it's pretty linear right now. When it gets really exponential like this, that's when your white line here is deep. This -8 is looking like a pretty deep backwardation, something along these lines. Remember, what we want to see is inversion back to contango, where risk in the present day is smaller than risk the next month, smaller than risk the next month, so on and so forth, to the point where this starts to flatten out into the future because, yeah, of course there's some risk in the future, but we're not going to trade in fear of that, right? We have to do something in the meantime. So anyways, watching for this to invert at a certain point. Right now, we do have the K contract. We might have to flip these for the week. We will have to flip these for the weekend, the K contract here. So we want J and what? Just to get an idea. No, we want K and M. K and M, so M minus K to jump over here. All right, we'll fix that for the weekend video. Even if you didn't want to use the white line because you're like, oh, those futures expire literally today, then you could use this cluster up here, which is still signaling a very similar indication. We're in backwardation, but much less of a steep backwardation. If you look at the same thing here out of the 9 versus 30-day VIX, all set with the move back to the 0 mark, and the 1-day VIX is the final shoe to drop on the volatility front. You're slightly higher out of the 1-day VIX, and that's obviously because it resets on 0 DTE SPX options daily. But if you take a look, what typically has happened in the past is when you make the move from the highs back down towards the lows of this range at 745, that is when it is OVER for the bears. So we're watching that closely. It has not really happened or triggered yet, but so long as we're underneath this upper consolidation, it steps in the right direction. We'll see what the rest of this week brings. Let's move on over to the core list of companies. Let's maybe give this set a reset. Let's jump into Nvidia. Nvidia. No dice on the hold of 104.75. This morning's gap down to the level didn't really leave us with a whole lot in terms of outcomes to really be focused on. Ideally, you would have opened over it for a test that either holds, or you open underneath it for a test that rejects. You do something that looks like that. Instead, we've closed right at the level, leaves a little bit to be desired, as I've said. So I think walking forward for the remainder of the week, which is really just the one Thursday session tomorrow, if we get consolidation over 104.75, maybe there's a gap fill trade overhead that's over 106.85, closes to 110.25. If we get that move, fantastic. Next step would be these equal highs at 114, which is a breakout point. Those are equal highs, very precise, as the improper end of the auction. If we could technically count lows, higher low here, you could split hairs with me. Maybe this is a higher low here. If we can get back up to the equal high, I would be thinking about an equal high breakout over time. Something to consider. Probably need some improvements. TSM earnings tomorrow morning will be a threat to Nvidia persisting here, right? The export fee is definitely a big one. It's why it's lower here in the first place, and it maybe dampens the outlook for future sales growth. But TSM certainly could allow for some sympathy out of Nvidia here as soon as tomorrow morning, really. Let's move along to Microsoft and see what's going on from this point of view. Not a great look out of Microsoft. The best thing for Microsoft would have been the gap down open that then drove into 377.25, held, then closed the gap overhead. That's not what's taking place. The reason that would have been most impressive is because we would have been staying within the previous lows from back here. Now, you have to flip the script and say, okay, any rallies that produce lower highs underneath that start to look bearish. If we can get risk reward back down to the equal low, it's a good first step, and then really looking for the follow through into the equal lows here. Earnings are later on in the month. We'll talk about them when they are relevant. Here it is on the hourly time frame chart once again. If the market was going to hold up in here before the Powell plunge, that would have been more bullish. It's not the case. Now there's an opportunity for a lower high to keep that as overhead supply, as well as all of the other weekly overhead supply that exists at 377.25. So your major threat is this right here. Let's take a look at Apple. How is Tim Apple doing over here? This is still the hourly time frame chart. This is fine for now. The gap down open underneath 200 was the nail in the coffin, leaving all of this as overhead supply. None of the pause on the electronic tariffs, none of that stuff really rippling through as being a saving grace. Not even the order, the big order that was placed of shipments and inventory ahead of the tariff enactment. So it has to be bearish below 200. I don't see the reason to be overly bullish here. I think that if this was going to produce a reasonable pullback, gap fill reversal, should have done something that looked like this. and we should have been working our way for higher. Is it possible that you go lows, maybe higher lows here? Yes. And again, you still have to be thinking about sound risk-reward principles. Why would you short into a previous area of resistance that could possibly act as support? Risk-reward isn't great here for shorts, but rally rejections that set a hourly lower high at 200 again could look something along these lines. Or if you break underneath 192, the intraday lower high underneath at least allows you some kind of risk reward into the equal lows here, 184.15, 182. Moving along to Nancy, what's going on with Amazon? Same concept. Please don't be just blindly short into 171. We actually talked about that live on the stream. Hopefully saved at least one person from shorting this smack into the lows at 171. It is undoubtedly relatively weak compared to the broad market. It was unable to sustain any price action over the neckline of its previous range back here. All of the rotation has brought it right back down to the bottom end of the range. So lower highs underneath 177 are the name of the game out of Amazon. Below that level, you have a lower high, equal low reattempt. That sets your initial risk reward. And then on the second test in short proximity of time after a lower high, that is where we increase the odds for the breakdown through 171 into the thin structure retracement. 162.25 becomes your target. If it's going to reverse, maybe you could get involved in this. To be honest with you, I would really need to see it up here over 183.50 before I start fishing for longs. Let's take a look at GOOGL. GOOGL resolving its kind of weird range here, and then here to the downside, and now once again giving an opportunity for either a lower high rejection at 157, or if this just Brigade bolts underneath 151.75, thin structure retracement brings you home into 144. If this was going to be a more bullish looking chart, it should have set a higher low here on the Monday-Tuesday interaction, reattempting the equal high and trying to get into the weekly overhead supply. Not the case, not working out as of right now. Bears are in control out of Google. If we take a look at the metaverse, another one that the bears are in control of, you can see that this never got really, as soon as the Wednesday rally faded, that was it. It was no love over 554. You can see the lower highs here on the Monday session just completely fading right down into Friday lows. The Tuesday Brigade bull underneath. Today's gap and go to the downside. Lower high underneath 503.25. Whereas a number of other charts that we've just looked at basically opened, call it a gap down still, but they've sort of stopped the losses at a key level. Meta said, nope, we're going through, and we're possibly setting a lower high underneath. So Meta is absolutely bearish here. I'd be looking for gap fill reversal lower highs. I would be looking for this structural lower high. Any consolidation here is a short-term hourly bear flag. Underneath prior day's low is a thin structure retracement, bringing you down to 475.85. Let's take a look at Tesla and what's going on with Mr. Musk. The Legion of Musks. Got to be careful with that. My goodness. Kind of a bizarre headline from some of the news outlets there on today's session, but the stock is fading underneath this balance range here. Any lower highs that persist underneath 241, equal low attempts, and then the equal low break brings you to the earnings gap fill, previous earnings gap fill. That's 218.85. So shorts can be on the table here, like many of the other names. This, if you just use Wednesday's bar as a reference point, right? A lot of this consolidation was taking place, even if you draw this in as what would have been the neckline of the double bottom, chopping and slopping through that and accepting underneath on today's session. That is a bearish takeaway versus a more bullish one here for Tesla. To be bullish and really compelled on the long side for Tesla, it would have to do a couple of things. This is a possibility out of Tesla. I would maintain this as an opportunity tomorrow. If we open underneath and get a Brigade bolt over 241, you technically have look below and fail. Target should be the opposing end of the balance. That's one way to get involved. The next way would be, okay, we open on, not a gap up because this is still today's range, but we open like here over 241. Pullbacks that hold 241 and then rally could bring the same outcome up towards 260. Please be respectful of these levels. They're helpers. We have 247 and then this level in here at 255.25. Those are the two ways to be thinking about Tesla into the end of the week. JP Morgan, in terms of checking in on the financial sector, doing all right, grinding in the upward direction. I would say that this higher low is still on the table here over some key structure pulling back from the highest high in the trend count, tangled up near the daily 200 SMA. Not the worst thing in the world out of JP Morgan. If this can hold 228.75, I would certainly be willing to say we have lows, higher lows, higher lows, higher lows here. This chart looks fine relative to some of the other tech that we've seen so far in today's episode. Lastly, Netflix, and then I have two trade ideas for you. One of them is a revisit. Netflix did complete the inverted man ray pattern here. We know that we have the head, the two shoulders, and the breakout on the Tuesday session, fading completely on today's session. The only threat here is earnings after the close on Thursday, so your IV on the options chain. Not that implied volatility isn't pumped up everywhere with what's going on out there right now, but it's going to be a little bit more so elevated and pronounced out of Netflix relative to some other things, so please keep that in mind if you're trading the options on this. The key hold has to be 950.25 going back to daily time frame charts. You can see why this, of course, was the origin of the entire breakdown from the neckline of the head and shoulders back here. If you can hold up above it, it's a good step to maintaining now the inverse head and shoulders, or inverted man ray pattern, if you will. Consolidation above then brings what? The next Brigade bolt would be here, back up towards the all-time highs. 1060 would be your target on that. Let's finish on a strong note. Let's save the best for last. So we'll start with J&J. Johnson & Johnson here. You can see that they already have earnings in the rearview mirror, and if we could stay over this kind of weird, I put a picture of this on X the other day. I thought it was just such a funny looking candle combination. If we could stay over the bottom end of that just absolutely absurd range at 153.15, then this bullish consolidation over the top end, let's go to the hourly chart now. You could see this, right? Call this whatever you want to call it, inverted head and shoulders, whatever. If we could stay over that on these two back-to-back bars and Brigade bolt over, we have thin structure off to our left. I'm really interested in maybe being over 155.75, trading into 160.50. The other thing that's nice about Johnson & Johnson in an environment like this is, say there's another tariff headline about electronics, this is going to be immune to that, right? To some degree, of course. Obviously, the rising tide lifts all boats, a sinking tide sinks all boats, but it's going to have some degree of immunity to that, so it's something to carry forward as an interesting outlier play, and the candle structure does make sense as well on the daily. Two back-to-back, longer-ish, lower wicks, hammer-esque style bars. Today was an inside bar relative to the previous day's session. A break of a classic inside bar high should yield continuation in the upward direction. That's the first trade idea. The second and last one is on PLTR, Palantir, fan favorite, of course. And it's similar, honestly, in terms of nature, if you want to call this inverted head and shoulders. But more so, I'm interested in the overshoot and the full gap close to the Friday high on today's session, the close at the 50 SMA. And if we get a breakout through these equal highs, looking left, there's thin structure from this volatile breakdown post earnings back here. I'm kind of into that. So holds of 90.75 consolidation. You could start calling this just a bull flag on the daily, right? That's fine. And then a Brigade bolt intraday over something like 97.55 brings you to 107.75. Here it is on the hourly time frame chart. Again, here's that gap close, so far responding to that structure into today's afternoon. I'm not saying it has to happen tomorrow on Thursday. We don't have to get there on Thursday, but this is certainly still a top watch as maybe consolidation in here and something that does that in the upward direction. So Palantir, fan favorite. We'll end on that note. Hopefully you enjoyed today's episode of the Midweek Market Update. You could call me a crazy, delusional bull in the comments section if you'd like. I've been getting plenty of that over the last couple of sessions here as we've outlined our base case for the higher low to hold. There are definitely still some threats. I'm not saying it's picture perfect, but it's getting there. It is getting there. So give me some feedback. Let me know what you think of the bullish base case down below in the comments section. Leave the video a thumbs up. It's another really simple way to support the stream here and the channel. With that said, we will be live tomorrow morning for our typical episode of the pre-market prep, kicking off at the 8 o'clock Eastern time frame. We hope to see you there. If we don't see you there, then have a green rest of your trading week. Enjoy the Friday session. It's a day off. And we'll see you in the next one, likely the Saturday update analysis. So stay green, and I will see you in the next one.